Ladies and gentlemen, I want to call this Life Insurance and Financial Planning meeting, 2023 NCOIL Spring National Meeting. We're here in San Diego, California, and it is 5:10 p.m., so that means that we're 10 minutes on the other side, right? So we're calling the meeting to order. No need for a roll call as time will be tight, and I will mark everyone's present. Okay?
Mr. Chairman, if I may, we understand after a long session like that, people want to spend maybe a few minutes just chatting, but we ask if you would take it outside. Thanks so much.
Thank you. I will mark everyone's attendance present today. So everybody's going to be present. Whether they're in here, outside eating pretzels, getting a little coffee, a little tea, drinking a soda, or even water. Everybody's going to be marked present. Even those persons that are representing a company today, if your company contacts me, I'm going to tell them you are present. Yeah, I don't know about that now. But I'm happy to see all of you today. In all things, we must always give thanks. So let us pray. O Lord, our Lord, how excellent is thy name in all the earth. We thank you for allowing us to be here today. We thank you for traveling grace and mercy. Be with us now as we go through this last meeting of the day. Protect us from all harm, hurt, or danger. Bless our families that we've left behind us, and bless all of those persons that are connected to us. Bless those that we represent, and bless this organization. Amen. Good afternoon. My name is Carl Anderson, and I'm a state representative in the nation state of South Carolina, and I will be chairing this meeting today. Now, I understand that this meeting is standing in between of your happy hour and your dinner. So that means that we're going to, do what we got to do and get out of here so you can go and do what you got to do. I ask for a motion to waive the quorum requirements. Do we get a second?
Second.
All right. Thank you. All in favor say aye. Those who oppose vote nay. The ayes have it. I also want to ask for a motion to approve the November 17th, 2022 committee meeting minutes. So move. Second. All right. Ready for the question? All in favor signify by saying aye. Those who oppose vote nay. The ayes have it. As I said earlier, we have a very busy agenda today, and we're already a little bit past 5 p.m., so let's get right down to business. We'll start by discussing the Life Insurance is a Promise for Life Model Act, sponsored by Indiana Senator and NCOIL immediate past President Travis Holdman. A copy of that model is on the website and the app, and is in your binders on page 138. Also in your binders, immediately following the model on page 141, is a resolution that was sponsored by Senator Holdman and adopted by NCOIL last summer, which served as one of the driving forces behind the Model Act. Just want all of you to know right off from the start that we will not be voting on this model today as it's being introduced and discussed for the first time. Before hearing from our speakers today, I'll turn things over to Senator Holdman for some introductory remarks. Please go ahead, Senator.
Thank you, Chairman Anderson, and I'll be brief. This model deals with two issues that may at first glance appear to be wholly unrelated, but when offered in the right context, you'll see the connection. Both issues are contained in the one model because they each deal with a long-term, often lifetime commitment of life insurance underwriting. The first issue deals with recent enhanced cash surrender value endorsements. Generally speaking, these type of products change the term of well-seasoned policies by incentivizing certain consumers to terminate policies and their death benefit protection in exchange for limited time, enormous increases in cash surrender value in plain violation of the standard non-forfeiture law. These products also carry substantial risk of the same sort as a regulated product. They mimic life settlements, but the carriers who offer them do not follow the consumer protection statutes created by legislators to protect policyholders such as rescission rights, intermediary fiduciary duty, physician certification of consumer competence, and disclosure of competing alternatives. Before turning to the second part of the model, let me say that the legislation does not impact enhanced cash surrender provisions offered at the time of initial contracting. Why the industry called two totally different items by the same name is beyond me. The second issue deals with the relationship between insurers and genetic testing information. The model permits an insurer to require disclosure of any information known to the applicant that is pertinent to the longevity risk posed by the insured, including genetic information resulting from any screening or testing. The insurer should be able to know what the applicant knows, and this seems only fair. However, the model makes clear that the policy can't be underwritten on the basis of a requirement that the applicant or insured individual undergo genetic testing or screening, and the issuance of a life insurance policy can't be conditioned on the requirement that the applicant or insured individual undergo genetic testing or screening. Taken together, these two issues relate to the life insurance principle that similar risks must be treated similarly, and that only after following certain laws can changes be made to an existing policy. I've introduced a bill in my home state of Indiana that essentially mirrors this model. While I have paused my Indiana bill for moving forward with the goal of reaching a compromise with some of the carriers offering these new cash surrender products, I want to keep the conversation going here at NCOIL in order to stay engaged with the issues and ensure that it doesn't drop off the radar. After this meeting, I look forward to discussing with staff as to what the next steps will be. One final note, I mentioned during the dialogue a few hours ago that I want to repeat it here for anyone that was not present at the dialogue and to ensure it's part of this committee's record. With regard to Section 4 of the model, I think there is a misunderstanding by some who view the language as asking for the Commissioner to rescind existing agreements that have been entered into between the consumer and the insurer. This is not the case, and frankly couldn't be the case that would get us into some constitutional issues surrounding interference of contracts. The model is only directing the Commissioner to rescind the regulatory approval of the forms on a going forward basis, so that doesn't impact any existing contracts. If the language needs to be tweaked in the model to make this more clear, I'm happy to work with that. And thank you, Mr. Chairman, and that's all I have at this time. Thank you.
Thank you, Senator. We have two speakers today. Mr. Nat Shapo, former director of the Illinois Department of Insurance, and now representing the Life Insurance Settlement Association, and Ms. Karen Melchert with the American Council of Life Insurers. We'll hold questions until both are finished. So I'm going to ask that the lady come first, and then we'll hear from the gentleman.
Thank you very much, Mr. Chairman. Good afternoon. My name is Karen Melchert. I am with the American Council of Life Insurers. You've all seen me up here before on other issues as well as this issue too. I want to thank Senator Holdman for his comments at the start that he recognizes that there may be some confusion with the way this model was drafted with respect to retroactive application, and we appreciate that your willingness to work with us on that language. I will say we do have some other issues with the language as drafted, as has been communicated with Senator Holdman based on his proposal in Indiana, and we would look forward to the opportunity to work with him to address the consumer protection concerns that you have. We do think that the use of these types of endorsements following consumer protection requirements are helpful for the consumer and offer them choices, and we would like to preserve the ability to offer enhancements to the policies in ways that are protected for the consumer and are transparent and according to the laws that are on the the books today. So we look forward to working with you as we move forward, both on your proposal in Indiana and here at NCOIL. We do not have any problems with the second half of your proposal here. So thank you very much for that. I'm happy to answer any questions, but that is the remainder of my remarks. Thank you.
Thank you, Ms. Karen. Now we will hear from Mr. Knapp.
Thank you, Mr. Chairman. As always, you're the most gentlemanly and benevolent of all rulers, so I appreciate always the opportunity to testify before you, and thank you very much for the time. And I'm Nat Schapper from Cat and Muchin, and I'm representing the lease of the Life Insurance Settlement Association. We've advocated for review of these enhanced cash surrender offers, which we believe are implicate the standard non-forfeiture law has been discussed. And also, I'd like to point out that one of the reasons NCOIL was most interested in the standard non-forfeiture law was as an example of a kind of a systemic NCOIL concern about that the standard non-forfeiture law was amended. The concern is about NEIC amending a model law and coming to the legislators and insisting that it be changed, and the legislators saying, okay, we're going to take this at face value and do this for you. And then the concern being, if it, having made a big deal about passing the laws, and then if they're not being enforced, or if other models are being pursued while this is being implemented. And so that was the issue here with the standard non-forfeiture law, that it was something that was changed in the model. It was asked to be changed by the NEIC, and then the question is whether it's being implemented. But I think it's important to realize there's also an unfair discrimination law issue, which is a fundamental consumer protection law that goes back, long before that. That's also in play here. The basics are, if you and I are identical risks and we get the same, we buy the same policy on the same day and pay the same premiums for 15 years, and then on yesterday you surrender for $50,000, or in the example we've used, it was a real life example, you surrender for $19,000, and I didn't surrender yesterday because I was busy, making my case at the NCOIL meeting to everybody I could find, and then I get an offer in the mail tomorrow for $360,000, and I accept it. Then you and I have paid the same, we're identical risk, we've paid the same premiums for 15 years, and you've gotten $19,000, I've gotten $360,000. Rhetorical question, how would you feel about that? I got paid 18 times as much as you did for the same price. Basic unfair discrimination issue. And the same thing on the back end. If we both got offers and I took mine at $360,000, but then you had an issue that you weren't sure you could accept it, the offer period expires, and then you want to surrender and you can't get the $360,000 anymore. Same thing. I've gotten 18 times the benefits for the same premiums. So that's the unfair discrimination law, and the standard non-forfeiture law smoothness requirement is attempting to get the same thing. But they're both independent bases for concern. On the model, Senator, ACLI's, I think, correctly likes the second part of the bill, but to me, the two parts of the bill both spring from the same issue, which is, as ACLI has testified, they said insurers underwrite or assess the risk only once. That is at the time of the application. Once underwritten, the price and the terms cannot be changed. That was in testimony here a few years ago. The life insurance is different, and there's multiple other instances where the life companies have said, look, we're different from PNC, we're different from health insurance. We get one chance to set the terms of the contract, and we live with those terms for 50 years. Which is why I agree that they should have access to all the information that the insured has, which is the second part of the bill. But the flip side of that is, if you're going to argue, look, we deserve these protections because we can't change the terms of the contract, and we underwrite once, and we have to live with our underwriting. Well, if that's the case, then you can't 15 or 20 years into a policy parachute in and radically change the method of calculating cash surrender value, because that's, both those ideas spring from the same idea, right? life insurance terms are set at application and issuance, and they're set for 50 years and they don't change. Therefore, the second part of the bill, life insurers need full information, but the first part of the bill, when it becomes convenient, they can't change the terms. And there's a consumer protection issue there, because if they change the terms 15 years in, then everybody who surrendered the first 15 years had no opportunity for that big enhancement. So that's our basic position, and we greatly appreciate. I appreciate your time, Mr. Chairman. I always appreciate Senator Holman's consideration and his rigorous review of these issues, and I'd be remiss if I didn't recognize his seatmate there, Representative Mayfield, who represents an area about 20 miles from where I grew up in Evanston. So it's nice to see you, and I appreciate the committee's indulgence in time.
Thank you, Director Chapo. And do anyone have a question? Okay, hearing none. I'm very sure that we've heard from the sponsor, Senator Holman. We've heard from the American Council of Life Insurers, and we've heard from Life Insurance Settlement Association. I'm very sure that y'all could get together before we come to the summer meeting and hash this out so that we can be ready for our summer meeting to put this in to some further motion. I'm counting on the three groups to do that so that when we come back during the summer, you all can come and say, hey, we are together and we're ready. So whatever you got to do to get it together, if it is go to happy hour after we meet here today, or do a Zoom conference call or whatever, we're counting on y'all to get it together so that we can be more prepared for our summer meeting.
Mr. Chairman, Ms. Melchert's about 20 miles from me the other ways, and she's got a better swing than I do, so maybe I could entice her to give me some tips on the first nice day of spring, and we could talk about it over 18 holes.
All right. That's what I like to hear. Good thing I started this off with a prayer. Senator Holman, do you have any closing statements?
No, thank you, Mr. Chairman, and we'll be fair in our discussion, and hopefully we can get something resolved. So thank you so much for your time. Appreciate it.
Yes, sir. Thank you, Senator. I look forward to the committee continuing to work on the model. Next on our agenda is a presentation on developments in California's life insurance policy lapse law. With us here today is Tiger Joyce, President of the American Tort Reform Association, and Dick Weber, Board Member of the Life Insurance Consumer Advocacy Center and the Ethical Edge. In your binders on page 144 is a bulletin from the California Insurance Department that provides some brief background on this issue. We'll hold all questions until both are finished. Go ahead, Tiger.
Mr. Chairman, thank you very much. Thank you. I appreciate NCOIL inviting me, you and your colleagues inviting me to speak about something that I hope you can help us to solve, which is the current, what we see as a new litigation frontier dealing with lapse litigation. Just a brief moment. Earlier in my career, I was counsel to a committee in the U.S. Senate. It seems to me this is an ideal issue for legislators to make sure that they make good policy here and not leave this issue to the courts. And I'll offer a little bit of thought about this and why I'm here to talk about this issue. I will just say at the outset that while the people at this panel, and I suspect all in this room, I am the least expert in insurance statutes, regulations and policy, but I'm here because this has moved into, at least here in California, the arena of my organization, the American Tort Reform Association. I'm hoping that all of you will reclaim this so that it doesn't become an issue for my organization going forward. It's, I think, especially appropriate that we're having, for me at least, to have this discussion here in California, because the litigation that has been our focus has taken place here in California, and it emanates from from statutory changes that were made with regard to lapse policy by the legislature a little over a decade ago. And as you can see, this was designed, and no doubt all of you know much more about this than I do, but recognizing different scenarios, trying to accommodate, no doubt, any number of different scenarios to ensure that there aren't inadvertent lapses of policy. And that's, my organization takes no issue with that and how that's done. But I think, just as my slide here indicates, extending the grace period. But I would particularly point to the third point, which is notices must be given at least 30 days before termination for non-payment of premiums. Well, like everything, this has found its way into the courts. And I think there are two major cases, and I'll walk through these very briefly. But McHugh versus Protective Life, which is relatively recent, as you can see, and I'll get to sort of the end of this in a moment. But interestingly, the trial court and appellate court rounds of this litigation dealt with whether the 2012, the statutory changes that went into effect a decade ago, whether they applied to cases that were entered into, to policies that were entered into prior to the statute. The statute was silent about that, but the trial court and the appellate court both were of the view that the statute, as was the case with most, were prospective, so the changes didn't apply to existing policies. And importantly, also the insurance commission, or at least the staff of the insurance commission here in California, supported that view and communicated that to insurers based on the information that we had. Now, California Supreme Court came to a different conclusion on retroactivity, and that attracted a lot of attention, and I think gave rise to further issues, including what we would call strict liability. And that was the question. That really is the question of whether any violation of this statute automatically creates liability, or whether injury must be proven, which is typically the case. I think lawyers, at least back when I went to law school, that's what we were educated on. And a recent appeals court decision, as you can see here at the end, took up that specific matter in the Protective Life in the McHugh case. And interestingly, the court seemed to suggest that it does not establish the so-called legal strict liability. And that's important. However, because it was a very fact-specific case, it didn't establish, and the court made it clear, this was not to be a legal precedent. Ultimately, this is going to go back to trial, and presumably it may find its way back to the California Supreme Court. Now, the next case, very similar, although it is Thomas versus State Farm. The difference is that this came through the federal courts, but the federal courts sitting in diversity. You can see here from my slide, two policies issued in 2008, premiums unpaid in 2016. The courts, both the Ninth Circuit on appeal and the Southern District of California, concluded that, in fact, under the 2013 statute, the statute that was enacted in 2012, that the policies did not, in fact, lapse. So, where does this leave us? I think rather than walk through a lot of different cases, I'm going to just quickly highlight something that a law firm here in California has concluded about both McHugh and Thomas, looking at them, recognizing these are the relevant cases. I'll just read this. I know it's not a good thing to do, and especially late in the day. But can the insurer of such policies, in this case, ever terminate them for failure to pay a premium? And the answer here is assuming that the insured is also the policy owner. The holdings would see, in both of those cases, would seem to apply that, in fact, no, these policies can never lapse for non-payment. Now, I don't know about you. Again, I'm not the expert here, but I actually earlier this year terminated a life insurance policy. It was fairly straightforward to do. To me, it's no different than handling a mortgage, handling the lease of a car, any number of contractual arrangements. But as you can see here, as this law firm concluded, because the insurer can never actually provide the owner the requisite 60-day grace period or provide notice of a pending lapse, and using their term, 30 days prior to the effective date of termination. It's just not possible, is what they conclude. Now, I don't know about you, that just doesn't strike me as particularly good policy. So where does this go? What happens here? This is where it comes into ATRA's territory. You can see, hopefully you find that somewhat amusing. But this is what we call the playbook of the plaintiff's bar. It's an invitation to litigation. It's an invitation to handle matters that really don't belong in the courts. As I said, in so many instances, this should be just simple matters of resolving contractual cases. Now, what are the key elements? Now, I should make an addition here. When we say here litigation in the #1 judicial hellhole, I should update that. My organization puts out a report on the worst litigation jurisdictions in the country. And actually, right now, Georgia is the #1 hellhole. I was there a couple weeks ago. They're celebrating 2 national championships in football. I reminded them they're also the worst litigation jurisdiction in the country. But California, until this past December, actually had that unique attribute. No proof of actual injury is required. That's an open question at this stage. I think the technical legal term for where does the litigation stand, I should have said this a moment ago, in the aftermath of these 2 lawsuits is it's a mess. It's unclear at best. And one of the most significant questions is whether to bring a successful case, does someone actually have to prove that they suffered an injury? I don't know the answer to that. And that's a matter, I think, for the courts to look at. And then the last point that I would make is a general matter, retroactive application of changes in statutes and regulations, unless expressly indicated, fundamentally disadvantages defendants in civil litigation in any number of areas. It's something that we feel quite strongly about. So where are we? The last we looked, there were about 20 class actions that have already been filed here in California. And what does that mean? That means you're going to see advertising, recruiting candidates for these class actions. And my organization tracks how much is spent on advertising. You can see that on the screen. Nearly $600 million was spent. That's just on television. That doesn't get into social media and any number of other tactics that are used. Another factor that's going to come into play is third-party litigation funding. And these are the large-scale investors who see a big return on investment in mass torts litigation that you see around the country, multi-district litigation and class action. And then the last point that I would make is simply that you pick your venue. Favorable venues yield the best possible results. So a few conclusions that I would make, not on the screen, but just first off, basic point is that we believe that courts should uphold and not rewrite contracts. And they should be faithful to the statutes that are enacted. I mention that because there are plenty of legal trends going in the other direction. For those who are lawyers, the American Law Institute has published a new restatement on the law of consumer contracts, which is basically an open invitation for judges to rewrite contracts. And I think insurance contracts are a prime target for that. So those of you who are involved in this policy area should be aware of that. The next point that I would make is no class actions. Every situation, we think, is different. My situation, if I were to allow a policy to lapse, would be different from the next person's. And the notion that they should all be treated the same, we think is inappropriate. But probably most importantly is requiring proof of injury. A basic tenet of contract law, tort law, any area of the law is you have to demonstrate that you've been injured. And if somebody has been injured, by all means, they should be allowed to bring a case and they should be allowed to recover. So for legislators, what I would make the following specific recommendations. Number one, don't follow the lead of California. If you're going to make these changes, make sure that they make sense. You all are the experts, but I can imagine that there are any number of ways to make policy on recognizing the different ways that people pay for life insurance policies, the timing, and just all of the machinations that go into it, and just take that fully into account. Be explicit on these consumer contracts. Courts are not your friend. You can't expect them to fix this. As I said, as someone who used to work in the legislature, I believe strongly that this is a great area for you to engage to avoid these kinds of problems. But then the final point that I would make is to recognize that this is a great area for you to legislate and the appropriate individuals to regulate. This is not an area for the courts and certainly not for the plaintiffs' lawyers. Thank you for your time, and I'd be happy to answer any questions.
Thank you, Mr. Tiger, and we certainly appreciate you enlightening us today. Do anybody have any question for? All right, come on, Mr. Dick, talk to us, man.
Mr. Chairman, thank you so much. As my insignia says, I'm Dick Weber. I'm a 56-year veteran of the life insurance industry. Yes, I was a child agent. I was a successful life insurance agent in the first half of my career, followed by 3 years as a home office executive. The second half of my career has been focused on consumers, working as a fee-only insurance consultant and currently the author of an ongoing column entitled In the Client's Best Interest, published in the Journal of Financial Service Professionals. In addition, I'm a consumer representative to the National Association of Insurance Commissioners, as well as serving on the board of the California not-for-profit organization Life Insurance Consumer Advocacy Center, or LICAC. I'm here to speak on behalf of consumers. I'm not an attorney, so I won't be dealing with legal issues. But it's about the dilemma that many policyholders can face, especially in older age, when personal bills and invoices can temporarily be overlooked or misplaced. It's one thing to miss paying a utility bill. You get reminders over a period of months before the utility is cut off, and when payment is restored, so is that particular service. This is not true with a missed life insurance premium payment. In some states, coverage can be irrevocably lost if payment is not received within 30 days of the billing date. This can be the case for a policy that's been in effect for decades, with tens of thousands of dollars diligently paid in premiums over those many years, suddenly lapse due to a missed bill or an errant delivery of a bill. Reinstatement is possible, but only if the insured is in excellent health, and this is rarely the case after owning a life insurance policy for many years. Recognizing this problem, as Tiger has alluded to, California enacted 2 code sections that were effective January 1st, 2013, establishing a 60-day grace period after a missed premium payment and requiring insurers to notify policy owners as well as third parties designated as by the policyholder to receive notice along with the policy owner, allowing at least 30 days before terminating a policy due to a payment lapse. In essence, this 60-day grace period we really think of as a 30 plus 30-day grace period. The first 30 days is the period in which the carrier is waiting for payment of the premium, and if not received the second 30 days, for notice to go out to the policy owner and their designee to allow time for an overlooked payment or a misdirected invoice to be discovered and the premium paid. California legislation prevents an insurer from terminating a policy for an unpaid premium, as you've been told, absent the requisite 30 days notice, as just described. And I want to acknowledge the rule doesn't say the insurance company has to provide coverage if premiums aren't paid. It simply adds a layer of security against unnoticed premium notices and the occasional instances where the premium notice is delivered to the wrong mailing address. LICAC agrees with the California Supreme Court's finding that this important protection should apply to everyone, not just for policies purchased since the legislation went into effect, but for all life insurance policyholders, regardless of when the policy was purchased. I'm not an attorney, as I've said, so I'm not going to expound on court rulings other than to briefly quote the California Supreme Court's 2021 finding on the issue, in which it found that retroactivity, that was the main issue, retroactivity of this 30 plus 30-day requirement, and I quote, fits the provisions language, legislative history, and uniform notice scheme, and it protects policy owners, including elderly, hospitalized, or incapacitated ones who may be particularly vulnerable to missing a premium payment from losing coverage, consistent with the provision's purpose. The Ninth Circuit of Appeals also ruled in favor of pre-2013 policyholder plaintiffs in actions against carriers whose terminated policies occurred without honoring the retroactivity. As I indicated, it's not just the policy owner might overlook a premium notice. I've recently experienced 2 instances in which carrier records became corrupted and the premium notice was not properly delivered to the policy owner. The insurance agent is usually a consumer's closest connection to the insurer, but in this first instance, the agent who sold the policy left the business, something that unfortunately happens all too often. Following best practices, the carrier transferred the policy to another servicing agent. Fortunately, the policy owner realized he hadn't received a timely premium notice, and when checking with the new servicing agent, who up to that point had no prior conversation with the policy owner, it was discovered that the carrier had inexplicably changed the billing address to North Carolina, a location where the policy owner had never lived. With the extra time required by California, the correction was made, the premium was paid, and the coverage remained in effect. In the second example, several years ago, I had a very similar situation with my own coverage. This was for a different carrier, but the same problem. It inexplicably changed the address of record to someone of my same name, but on the other side of the country. We caught it in time, and my point is that these types of situations do occur, and the 30 plus 30 time frame provides a critical margin for the time it takes to correct the problem. A third situation occurred to me just this week by coincidence. I had been named as the third-party designee on a policy purchased a number of years ago, which had for some reason gone unpaid during the 30-day renewal period. I'm quite certain that without the reminder from me as a designated third party, the premium would have gone unpaid and the coverage would have lapsed. Our firm has heard of these mishaps occurring over the years. How often, I can't tell you. 1 in 100, 1 in 1,000. We believe that any are way too high, given the unique nature of a life insurance policy purchased to provide financial security to a beneficiary, especially when it's so easy to provide for a third-party notification and have the time to take corrective action. I believe there are a number of carriers that are generally improving in the area of getting premium notices to the correct owners and providing for the requisite time frame. But there are also a number of carriers who are resisting the retroactivity, finding of the California Supreme Court and or attempting to keep such regulations at bay. and the need of retroactivity from being enacted in their states. We believe there will always be the occasional misdirected premium notice and elderly policyholders who unintentionally miss making a premium payment, and that California's consumer-focused innovation is the only sensible way to handle these situations. It's not an unreasonable burden on insurance companies. That was the conclusion of the California Supreme Court. And it's a lifesaver. I guess I can call it a life insurance saver for those who are having difficulty managing their paperwork. There's approximately $21 trillion of life insurance in effect in the United States today, owned and paid for the ultimate policy beneficiaries. On behalf of all policy owners, we encourage departments of insurance and state legislatures to review and emulate California's rules to help keep life insurance policies from inadvertently lapsing. These are consumer-focused requirements that should be in effect in all states. So I would suggest, indeed, follow the lead of California. Thank you, Mr. Chairman.
Thank you for educating us, Mr. Dick. And certainly we want to say thank you to Mr. Joyce and Mr. Weber, and I think we ought to give them a round of applause for sharing this presentation with us today.
Mr. Chairman, if I may, can we just make it clear that 72% of the applause was for Mr. Weber?
Well, I don't think that Mr. Joyce would mind, Mr. Joyce, I understand that, y'all are friends. So friends do,
Or we were.
So now that means that he's got to pay for your drink today. Thank you, gentlemen. And, this happens. But thank you for sharing what is going on in California to let us know that we are, subject to some of the same thing to happen in our states. And certainly, this has been a breath of fresh air with both of you sharing with us today. Thank you again. Last on our agenda today is a presentation on the new federal retirement security law, the Secure Act 2.0. Yeah. We'll hear from Ms. Kathleen of the ACLI. You can view some of background material on the Secure Act in your binders on page 146. Come on, Ms. Kathleen, you're standing in between these two gentlemen and getting their happy hour.
Thank you, Mr. Chairman, and I will be brief. I don't want to prevent anyone from getting their cocktail. I really appreciate the opportunity to speak with you all about the Setting Every Community Up for Retirement Act, or Secure 2.0. We love acronyms in D.C., and so we try to make them as long and difficult as possible. Retirement security on the federal level continues to be a bipartisan effort. We've seen 2 comprehensive retirement bills passed within the past 3 years, which is somewhat unheard of. And so that really demonstrates the need for both continued improvement to the retirement system, but also an appetite by lawmakers to continue to legislate in this area. The Secure Act, the original Secure Act, was passed and enacted in 2019, and it really focused on expanding access to savers, and this included part-time workers, those working for small businesses, and those who hadn't previously had access to a retirement plan in the workplace. A pooled employer plan arrangement would allow for small employers to pool their resources, achieve economies of scale, and to implement a plan in the workplace, something they might not have been previously able to do before. And by our estimates, that would create 700,000 new savers alone just through that provision. Fast forward a couple of years to this past December, Secure 2.0 was enacted and focused improvements really on vulnerable populations that included part-time workers, those at or near retirement, caregivers, women, low and middle income earners, and military spouses, just to name a few. The secret sauce really to two huge retirement bills passing the U.S. Congress, where some joke good policy goes to die, was really, there were several elements that helped to achieve that. The first being, like I mentioned earlier, is bipartisanship. Nearly every provision included had both a Democratic and Republican co-sponsor that championed that provision within the larger package. We also saw heavy committee engagement with committees of jurisdiction in both House and Senate, working together to pass their respective packages out of their committees, sometimes unanimously, which is sometimes unheard of. The bill was also paid for, so cost, of course, is always a factor that we keep our eye on. And by paying for the bill, we were able to attach that to must-pass legislation, both bills passing at the end of their respective years. And lastly, industry or stakeholder support. ACLI was heavily engaged in the direct advocacy on both bills, and really having a lot of different stakeholders at the table helped to put some wind in the sails of both those retirement bills. I'll touch briefly on some areas of constituencies that were heavily impacted by provisions within 2.0. The first just being general savers who could benefit now from automatic enrollment, which would allow for all new plans a federal mandate that all new plans have automatic enrollment. As we all know, automatic enrollment and auto escalation are key tools that have increased retirement savers' retirement balances. And so utilizing this tool for all new plans, we think will really make quite a big of an impact. Our estimates look at $34 billion in new savings over the next 10 years alone. Additionally, allowing employers to match what their employees are paying towards their student loans into a retirement account allows them to retain, recruit new workers, but also to help those folks who may be sidelined paying for those student loans who have not saved yet for retirement to start a retirement plan or to contribute to their retirement plan. Another provision also looked for a way for workers to locate old accounts. When workers transition into new jobs, sometimes those accounts they forget about, they leave it at an old employer, they may not roll over. So the lost and found provision within the bill allows employees to locate any old account that they may have contributed to ensure that they never lose any of that retirement savings. I mentioned military spouses. One unique feature of the bill would allow military spouses who historically may move quite a bit with their spouse due to relocations through the military to be vested within an earlier time frame, allowing them to have access to those retirement accounts in the workplace. And also something that we saw coming out of COVID-19, we saw a lot of distributions from retirement accounts. And to kind of combat that, there were several provisions that dealt with emergency savings, both in a sidecar type model, which allowed folks to save in a short-term savings account that could roll over ultimately into a long-term savings vehicle, but also looking at relaxing some of those hardship distribution rules, waiving the penalties associated with those to allow employees to take out a loan or a distribution from their retirement account and be able to pay that back for a short-term emergency savings event in their life. We also saw incentives for small businesses, new incentives that would allow those small businesses to offer a retirement plan in the workplace. We estimate that will generate at least $20 billion in new savings over the next 10 years. I mentioned a pooled employer arrangement earlier as part of Secure One. That was expanded to allow 403B plans to also have access to those pooled employer accounts. I mentioned low and or vulnerable constituencies that would be affected by 2.0. This includes low and middle income earners. They've enhanced what's called the Savers Credit, which wasn't very well known, and the utilization wasn't great. So they're streamlining that credit, and they're also taking some steps to let folks know that that's available in a variety of different ways to increase savings rates among low and middle income earners. Those at or near retirement, such an important segment. Sometimes these are women and caregivers who've been out of the labor force. allowing them additional time to save in their retirement accounts by pushing out the required minimum distribution age. Secure 1 pushed that to 72 and a half, and we saw now with Secure 2, the required minimum distribution age is now at 75. We also saw a catch-up contribution improvement that allows those 60 and older to contribute up to $10,000 once they reach that age, to try to increase their retirement balances as they approach retirement. We estimate that this will help older workers save an additional $8.5 billion over 10 years. So what's next? We're in the implementation phase of 2.0. That includes a variety of different government agencies, including Treasury, Department of Labor. The effective dates are staggered for the more than 60-plus provisions included in 2.0, so it will take some time. There's also a need for some technical corrections. An inadvertent drafting error removed a critical paragraph that would allow catch-up contributions in general, starting in 2024. So that will have to be remedied either through a government agency or through a technical fix. We think the latter is more probable. There's several different technical corrections that will need to be made to the bill, and we anticipate that that will occur by the year's end. So in general, I think I'll just leave you with this bill will affect a lot of your constituencies in a very positive way. While it's being implemented, the ACLI continues to monitor some of those positive impacts and are happy to work with you and your staffs and to talk through what are some of those benefits for your constituents. And with that, Mr. Chairman, I will yield back my time.
Wow. Thank you, Ms. Kathleen. This is very informative to all of us, and I hope that we would take our book home with all of this information and share it with those persons that we serve with in the House. I just want to say that I share with young people all the time because I'm a business major. I share with them all the time about what to do when they get on their jobs. And I've been blessed to have 3 jobs that has afforded retirement. And one of those jobs was my family business, a furniture and appliance store. And through that, me now employed by the state of South Carolina, I was able to purchase some years from that retirement account that, is put into my state retirement account. And I share with young people, on the job, another one of my jobs, I had to be on the job for 7 years. And I worked 7 years and 3 months because everything I put in the retirement, they matched it. And so I tried to share with young people, stay on the job long enough that you are vested, And in state government, we needed 8 years, and I'm very happy to see one of my colleagues that served with me in the House, Mr. Marty Coates, that's sitting over here to my left. We were a part of that, 8 years and being vested in state government. And so there were 12 of us that got elected that year. And one of the things that we said that, we're going to stay 8 years to make sure that we're vested in the state retirement. And I've been there now 19 years. Marty left us to go on. But the system works. And I share this with young people and everybody to make sure that you are on a job that has a retirement system where you can put in. And the other key to that, and you said it, not just the job having it, but make sure you are part of it and you put into it. And so thank you again for your presentation, and I'm sure that we will definitely be working on this. Again, thank you. Any questions, any comments? Oh, y'all must be really ready to go. Well, guess what? It is 6:04 p.m., and the meeting stands adjourned.